Yeah, good evening, Ankit. Good evening, Vibin. Good evening, Satish. You have any questions that you'll have? Otherwise, we'll just start maybe in a minute or so. Yeah, good evening, Jyotishman. Okay, then let's start. Let's do a recap of what we did in the previous session. So if I look at the previous session was the one where we started with ratios. And in that session, what we did is, just give me a second. Yeah. So in the previous session, we looked at these three ratios, that is liquidity, profitability, and solvency. So we covered different ratios in liquidity. The important ones typically that companies or anyone who's working in the industry would look at would be the current ratio, the quick ratio, and then your debtors, creditors, and inventory holding period, the cash conversion cycle. Then we looked at the profitability ratios, be it the gross profit ratio or the net profit ratio, and then either return on equity or return on capital employed, return on asset. And then solvency ratios, which talks about whether the company has too much of debt, whether the company will be able to fulfill and pay off its long-term liabilities on time or not. So we looked at debt service coverage ratio, interest coverage ratio, debt equity ratio, and debt to asset ratio. Any questions on this before we start with today's session? So this is what we'll be covering in today's session. Yep. Any questions till here? Okay, fine. Then let's look at what we'll be covering in today's session. So in today's session, we'll look at the fourth set of ratio, which is basically the turnover ratio or the efficiency ratio. Then we'll also look at DuPont analysis, which is nothing but an extension of return on equity. So DuPont will tell you the factors which influence return on equity. And then we'll look at other financial tools that can be used for, let's say, analyzing a company. Typically, that will be your comparative and your common size. So let's look at the turnover ratios. So if you look at turnover ratio, as the name suggests, the turnover ratio, the efficiency ratio, you're basically talking about and saying how efficiently the company is being run, is being managed. And okay, Yunus has sent a question. Can you please explain cash conversion cycle, operating cycle time? Okay. Yep, Yunus, let's do that. Okay. So Yunus, let's say I sell goods to you on credit. So I'm the vendor, I'm the supplier, and I sell goods to you. So when I'm selling goods to you, I tell you that, okay, you make a payment after 2 months. So you will make a payment after 2 months. So I will get the money as a supplier. I'll get the money from you after 2 months. This 2 months that I give to you, because you are my customer, you are my debtor, that's known as debtors collection period. How we calculate that, we'll cover it today. So in the last session, we just looked at the concept, what is debtors collection period. So that's the time which is given to the customer to make a payment to the vendor, to the supplier, to the company. Then, because I'm selling goods to you, I would have purchased the raw material, I would have produced the goods. So I went to my supplier and I purchased the raw material. And let's say my supplier gave me a credit period of 1.5 months. So whenever I purchase the goods from my supplier, after 1.5 months, I have to make a payment to him. So that person becomes my creditor. So this 1.5 is nothing but your creditor's payment period. At the same time, after producing goods, it's not necessary that immediately I sell off the goods. The goods will remain in the go down for a few days, weeks, or months. So let's say after the goods are produced, the goods remain in the go down for, let's say, another 1 month. So this 1 month for which the goods are there in the go down is known as typically your inventory holding period. So when I'm calculating my cash conversion cycle as a company, then I'll say, okay, I'll take debtors collection period, I'll add the inventory holding period, and I'll reduce the creditors payment period, which means my operating cycle time or the cash conversion cycle will be 2 months, which is debtors collection period, plus 1 month, which is inventory holding period, minus 1.5 month, which is creditors payment period. So my operating cycle time becomes 1.5 months. So operating cycle time basically tells you when the money is going out of your pocket and when the money will come back into your pocket. So this time frame in our example is 1.5 months. So that's your operating cycle time or cash conversion cycle. Any doubt with this? No. So I mean, I call it debtors collection period. Some people call it as let's say sales outstanding, days sales outstanding. It's the same thing. Yeah. So it's not nothing different. It's the same thing. So, yep. Okay. And let's go back to this. So let's look at the turnover ratios. So basically, we'll be looking at 4 to 5 turnover ratios. We'll look at fixed asset turnover ratio. Then we look at current asset turnover ratio, where we look at debtors turnover ratio, inventory turnover ratio. Along with this, I also want to capture creditors turnover ratio. So this is one thing that we'll also look at. And then finally, we'll look at the total asset turnover ratio. So let's look at these 5 numbers. And when we're looking at debtors, inventory, and creditors turnover, we link it to debtors collection period, creditors payment period, and inventory holding period. Let's first look at fixed asset turnover ratio. So when I'm looking at a fixed asset turnover ratio, it basically tells me what proportion of, let's say, sales I'm generating with respect to the fixed assets that I have. So if I want to calculate my fixed asset turnover ratio, fixed asset turnover ratio is nothing but sales upon your fixed assets. So let's assume, let's put some numbers here. Let's say my sales are 1,000 crores and I've got fixed assets worth maybe, let's say, 1,000 crores. So I've got a fixed asset turnover ratio of 1. And let's say this is company A. Then I've got another company, company B. This company has sale of 1,000, but has fixed assets of only 100. So this company has a fixed asset turnover ratio of 10. Now, can you think of companies or sectors which will belong to A category and companies or sectors which will belong to B category? Yeah. Anyone? Companies or sectors which will belong to A category. B would be an IT company. A is manufacturing, heavy, great. So A is typically a capital intensive sector and B is typically an asset light sector. So an asset light sector will typically have less of assets and they'll have more sales that they are generating from those assets compared to, let's say, the first one. If you're capital intensive, maybe typically if you're looking at companies like, let's say, oil and gas, metal and mining, infrastructure companies, port companies, all these companies will have a lot of fixed assets and therefore their fixed asset turnover ratios will be low. Compare this to, let's say, retail companies, FMCG companies. And these companies will have less of assets. Compared to that, they'll generate a lot of sales and therefore their asset turnover ratio, the fixed asset turnover ratio, would be higher compared to, let's say, the companies which fall in the A category. Now, again, if you remember, we discussed something in the earlier session. Companies which have a low fixed asset turnover ratio will tend to have a big gap between the EBITDA margin and the net profit margin compared to companies which fall in the B category. The reason being, if you're capital intensive, you will have a lot of fixed assets and you'll end up having a lot of depreciation. Because you're capital intensive, chances are that you would have taken a lot of debt, and because you'll have a lot of debt, you will have a lot of interest component. So such companies, the EBITDA margin and the net profit margin, the gap would be higher. So maybe the EBITDA margin could be, let's say, 30% and the net profit margin could be, let's say, 15%. But let's say if you're falling in the B category, then this gap will not be so big. So this gap will not be like 15-20%. This gap will be narrow, maybe 5%, 6%, 8%, 10%, so on and so forth. Because these companies will have less assets, so less depreciation. They'll not be so capital intensive, so they'll not have too much of debt. So the interest component will be less. So the gap between the EBITDA margin and the net profit margin for companies which fall in the B category would be smaller compared to the companies which fall in the A category. Any questions still here? So if you're looking companies like Zara's, Marks and Spencer's, Shoppers Stop, all these companies, retail outlets, they'll typically have a higher asset turnover ratio compared to, let's say, if I'm looking at Reliance Industries or maybe Adani Ports or something, they'll typically fall in the A category where the fixed asset turnover ratios will be low compared to, let's say, the B category companies. Any questions on the fixed asset turnover ratio, which is sales upon fixed assets? No, you'll take net sales. You'll take net sales over here, not the gross sales. So you'll take the net sales, which is after deduction of taxes, sales returns, and everything. Take your net sales. Okay, Abid has raised his hand. Just give me a second. Yeah, Abid.
Good evening, sir.
Yeah, Abid, tell me.
So my question is that mostly the retail companies and the FMCG companies and all, they will be focusing on EBIT rather than the EBITDA, right?
Yeah, so again, because for them, EBITDA, depreciation, amortization is not a main concern for them, because depreciation, amortization will not be a big number. Again, look at a typical retail entity. What is the biggest cost for them? The biggest cost for them will be the inventory, the stock that they have. Then it could be the employees and the salaries and the wage cost that they have. Compare this to, let's say, a port company or maybe Reliance Industries. They'll have huge depreciation and everything. They'll have a lot of interest costs. So they could be focusing more on the EBIT margins.
Sir, but the retail companies would also have the stock storage expenses like warehouse expenses and all that.
They'll have it. But then let's compare the warehouse cost, the storage cost, the insurance cost that they'll be incurring compared to, let's say, the depreciation that Reliance Industries will be charging, let's say, on its Reliance Jamnagar refinery or it's on its towers, so on and so forth.
It will be very high, yes.
It will be very high. So again, I'm not saying it will not be there, but the number, when I'm looking at the quantum, that quantum will be quite small compared to the capital intensive companies.
All right, yeah. Thank you.
Okay. Any other questions on fixed asset turnover ratio before we look at total asset turnover ratio, which is an extension of your fixed asset turnover ratio? Okay, what is EBITDA? Okay, anyone from the batch who would like to say what is EBITDA? There's a question, what is EBITDA? What is this? Okay, fine, let's look at it. EBITDA is nothing but earnings. That's nothing but your profit. So earnings before interest, tax, depreciation, and amortization. So this is the profit that the company is generating before paying interest, before paying tax, before charging depreciation and amortization. Again, if you remember your income statement, typically if you look at your corporates, how they make their income statement is they will take their total income and then they start reducing expenses. And initially what they'll do is they'll take their expenses, but without capturing depreciation, amortization. And finally, what they'll get is they'll get something like EBITDA. Then from this, they will reduce depreciation, amortization. They'll get earnings before interest, tax. Then they deduct interest. They will get profit before tax. Then they'll deduct tax. And finally, what they'll get is profit after tax. So we're talking about this now. Okay, fine. Then let's look at total asset turnover ratio. Again, if you look at a total asset turnover ratio, total asset turnover ratio is nothing but it will be sales, but instead of dividing it by the fixed assets, I will divide it by total of the assets, which means I'll divide it by fixed assets as well as current assets. Okay, got a question. What is amortization? Okay, so what is amortization? This one. Anyone who would like to say what is amortization? We know what is depreciation. In fact, we discussed it in the last session also. But anyone, what is amortization? This A is amortization. So what is amortization? Anyone? Writing off of the intangible asset. Great. So let's say I've got goodwill. Goodwill is an intangible asset. So along with goodwill, I can have a lot of other intangible assets, know-how, patent, copyrights, all of that. Now, these assets slowly and steadily over a period of time will lose their value. So you have to bring it down, you have to write them off. So when you write off an intangible asset, that is known as amortization. But when you write off a tangible asset, for example, let's say you got a machine, then that reduction is known as depreciation. Okay, got another answer from Vijay. Paying off debt with regular payments. Vijay, that amortization that you're talking about is with respect to debt. Fine. So that again is amortization, because what you typically are talking about is an amortization period. So what you're saying is amortization period, moratorium period, gestation period, right? Loan is not an intangible asset. No. So we'll not categorize loan as an intangible asset. First of all, if I am taking a loan, it is a liability. It's not an asset. So loan when you take, again, if you remember during COVID, RBI and what the banks did is they typically gave you a waiver and they said, okay, because of COVID, especially I think it was 2020, they said, okay, if you have taken a loan and it's a special loan, maybe typically farmer loan or something else, or maybe even for corporates, if you've taken some loan and you're a small company, they said, okay, you need not pay, let's say for the next 6 months or something, because we know that this has suddenly come in, COVID has come in, you're not generating any business, the business is shut down. So that was typically a moratorium period. So moratorium period is a period where either you pay nothing to the bank or you pay only interest to the bank. Again, look at an example. Let's say if you are a student and you've taken an educational loan. Okay, so you go and take an educational loan for your higher studies. Banks will typically give you a moratorium period. So they'll say, okay, 2 years of MBA that you're doing, if it's a full-time MBA, then we'll not charge you anything. So that's a moratorium period. But after that, we'll start your EMIs. That's known as a amortization period. And that could be, let's say, 5-year or a 10-year or a 3-year loan, depending upon the agreement entered into and what is the loan amount taken. So 2 years, the first 2 years where you pay nothing or only interest to the bank, that's moratorium period. And then when you start with your EMIs, you pay the interest and the principal component, that is your amortization period. So that is a different amortization. What we are talking about is EBITDA, that is amortization, or that is writing off of the intangible asset. Yep. Anything else? Otherwise, you move back to total asset turnover ratio. Okay. So let's look at total asset turnover ratio. So total asset turnover ratio is similar to a fixed asset turnover ratio, but in a fixed asset turnover ratio, denominator was fixed assets. Here denominator is total assets. So you'll take all the assets that the company has in the denominator. Numerator will be your sales. So again, if you're a capital intensive company, chances are that your total assets will be far more and bigger in number compared to an asset light company. So again, your total asset turnover ratio could be lower. So again, generally when I'm looking or trying to identify whether you're a capital intensive company or not, I'll basically focus on a fixed asset turnover ratio rather than looking at a total asset turnover ratio. Because let's say a company which is not that capital intensive could be having a lot of inventory, stock and all that stuff, which is typically a current asset. So that company at the end could also have decent levels of total assets, but may not have a lot of fixed assets. So if I'm trying to look at it and find out whether you're a retail company or let's say whether you're a petrochemical company, Fixed asset turnover ratio will give me a better picture compared to just, let's say, a total asset turnover ratio. So any doubt with fixed asset turnover ratio or the total asset turnover ratio before we look at debtors, creditors, and inventory? Okay, and let's look at debtors turnover, inventory turnover, and creditors turnover. Let's look at debtors turnover ratio, creditors turnover ratio, and inventory turnover ratio. Now, debtors turnover ratio can be linked to debtors collection period. Creditors turnover ratio can be linked to creditors payment period, and inventory turnover ratio can be linked to inventory holding period. Now let's try and understand what this means. We already know what is a debtors collection period. Debtors collection period is the time that we give to our customer, our debtor, to pay back the money. Creditors payment period is the time that we get to make the payment to our supplier. And inventory holding period is the time for which the goods are there in the go down. It's not yet sold. We still have it in as our inventory in the warehouse. Now let's try and link this to the turnover ratio. So be debtors collection with debtors turnover, or creditors payment with creditors turnover, or inventory holding with inventory turnover. Now tell me, would you like your customer to delay the payment, or would you like your customer to make the payment as quickly as possible? So would you want your debtors collection period to be long, or you want it to be short? So you want this to be extremely short. You want to receive the money as quickly as possible. Let's look at creditors payment period. Now you are supposed to make a payment. So do you want to delay the payment, or you want to make the payment immediately, maybe today or tomorrow, or you say, okay, I'll make the payment after 1 month, 2 months, 6 months, or maybe a year? You would like to delay it as far as possible. Let's look at inventory holding period. Do you want the inventory to sit in the go down for months and weeks, or you want the product to be produced and it should immediately get sold off and it should move out of the warehouse? Immediately sold off, which means within a short span of time, the goods should be sold. It should not be there in the go down for, let's say, weeks and months. Otherwise, typically you'll end up saying that your inventory is not a fast moving stock, it's a slow moving stock. So you want your debtors collection period to be low, you want your creditors payment period to be high, and you want your inventory holding period to be low. Now let's link it with turnovers. Debtors turnover ratio basically tells you how quickly or how many times your debtors are making the payment in a year. So again, let's try and understand this with a number. So let's say I've got 360 days in a year. For simplicity, let's say 360 days instead of 365 days in a year. So there are 360 days in a year. And I tell you that my debtors are turning around 36 times in a year. So debtors are turning around 36 times in a year. What does it mean? I sell goods, then I receive the money. Then again I sell goods, I receive the money. Then again I sell good, I receive the money. And this happens 36 times in a year. So you sell the goods, you receive the money, then again you do this, and this happens 36 times. And that's your debtors turnover ratio. So debtors turnover ratio tells you how many times your debtors are turning or churning around in a year. So if you know that there are 360 days and your debtors are turning around 36 times in a year, can you tell me what will be your debtors collection period? Okay, got a question. Cycle of sales to payment. Yeah, cycle of sales to payment. Yeah, it will be 10 days. So debtors collection period will become 10 days. So how do you link your debtors collection period to your debtors turnover ratio? Debtors collection period will be, I've taken 360 days, but let's say if it is 365 days, so it will be 365 days divided by debtors turnover ratio. So that's how you'll calculate your debtors collection period in terms of days. So if you want to calculate your debtors collection period in terms of days, take the number of days in a year. So if the question is silent, take it as 365. If the question says take it as 360, then take it as 360 and divide it by the debtors turnover ratio. So So in our case, the number of days are 360. Debtors turnover ratio is 36, which means my debtors collection period is 10 days. So if I sell the goods today, I get the money in 10 days. Then again, if I sell the goods, I get the money in 10 days. And this keeps happening 36 times in a year. So that's your debtors turnover ratio. Now the question is, how do you calculate debtors turnover ratio? Anyone? So now we know how do you calculate debtors collection period, which is 360 upon or 365 upon debtors turnover. Now how do you calculate debtors turnover ratio? Yep. Anyone from the batch? How do you calculate debtors turnover ratio? This number. Debtors turnover ratio is nothing but you will take credit sales. Don't take total sales. You will take credit sales because debtors happen only if you have credit sales. Credit sales upon your debtors, or let's say accounts receivable. So take debtors, bills receivable, whatever you have, that's your accounts receivable. So you'll have debtors, you'll have bills receivable. So that is the amount of money that you're yet to get back. So that becomes your accounts receivable. And take your credit sales. Don't take total sales because total sales will include cash sale and credit sale. Debtors arise only if there is a credit sale. So debtors turnover ratio is credit sale upon accounts receivable. Okay, got a question. Just a second. Net credit sales, gross sales, credit sales. Okay, net credit sales shall be minus selling and general admin expense from where? From the sales? Abid? You're saying that we'll minus selling and general admin expense from the sales? No. I'll take the total credit sales. So let's say I have total sales of 100 crores, out of which 20 crore is cash sale and 80 crore is credit sale. This 80 will come in the numerator. Huh?
No, sir, that is clear.
Huh.
My point was that, for example, for selling that 80 crore, I have incurred an expense of 2.5 crore. So while I'm calculating the DTOR, will I deduct the SGA? That is the selling and general reason?
No. I'm not, because over here I'm just looking at the sale part. I'm not looking at the expense related to that sale, because I'm just trying to find out in how many days my customer makes a payment to me. I'm not calculating my profitability ratios over here that I'll deduct the cost over here. So I'll not do that. So I'll take the sales and I'll say, okay, my total sales is, let's say 80 crores. So I'll take that. And let's say I've got debtors worth, let's say maybe 40 crores. So I get a debtors turnover ratio of 2. And then accordingly, I'll calculate my debtors collection period. Debtors collection period will be 360 upon 2, which is 180 days. So take your total credit sale. Don't deduct your SG&A expenses, nothing. Whatever is your credit sale, take that. Now be careful. Don't take total sales. Take only credit sales. Don't take cash sale. Yep. So any questions on debtors collection or debtors turnover? So again, just to recap, debtors collection period, if you want to calculate, it's 360 or 365, whatever is given in the question, divided by debtors turnover ratio. So take your debtors turnover ratio, and debtors turnover ratio is nothing but credit sales upon accounts receivable. So take your debtors, bills payable, bills receivable, put together in the denominator, and finally you'll get your debtors collection period. On similar lines, you can do for your creditors and you will do it for inventory. So let's say if I want to calculate creditors payment period, how will I calculate? I'll take 365 and I'll divide it by what? So over here it was 365 divided by debtors turnover ratio. So creditors payment period will be 365 divided by not the payables, it will be divided by creditors turnover ratio. Okay, so creditors turnover ratio, and for calculating creditors turnover ratio, I'll take the payables. So if you want to calculate the creditors turnover ratio, so over here you had credit sale, here you will take credit purchase, because creditors will happen only if it's a credit purchase. If it's a cash purchase, there is no credit. So creditor will happen only if there's a credit purchase. So in the numerator, I'll have credit purchase, and denominator, I'll have accounts payable. So I'll take my creditors, bills payable in the denominator. That will give me the creditors payment period. So as a company, you want debtors collection period to be low, which means you want your debtors turnover ratio to be high. So there's an inverse relationship. Okay, Abid, you're saying creditors turnover. Again, just go, if you've understood debtors, the same logic is there for creditors. So if I want to calculate debtors payment period, I'll take 365, that is as it is. Then instead of debtors turnover ratio, I'll move to creditors turnover ratio. So instead of debtors, I'll have creditors. Then for calculating debtors turnover ratio, what I did is I took credit sales divided by accounts receivable, because debtors happen only if there is a credit sale. But when do creditors happen? Creditors arise if you have a credit purchase. So instead of credit sale, I'll have credit purchase. And instead of having accounts receivable, I'll have accounts payable in the denominator. Okay, got a question. Is credit sale not equal to accounts receivable? No. Can anyone tell me? It may or may not be the same. So it's not necessary that it will always be the same. It may be same, it may be different. How? Anyone? Credit sale and your debtors, they're not the same. Anyone? Okay. Let's say I've sold goods worth 100 crores on credit to you on 1st of April 21. So this becomes my credit sale. And let's say this is the only credit sale that I have during the entire year 21-22. There is no other credit sale. So that is my credit sale, which is 100 crores. And on 1st of April, you are my debtor also worth 100 crores. But during the year, let's say you've made some payment to me. Let's say out of 100 crores, you've paid 80 crores to me. So when I calculate my debtors as on 31st March 22, my debtors will not be 100 crores. My debtors will be 100 minus 80, which is 20 crores. But on 31st of March 22, when I'm making my income statement, I will say my credit sale for the year is still 100 crores. So credit sale is 100 crores, but debtors as on 31st of March will be different because of the money that you would have received, or maybe there is some bad debt or whatever it is. So debtors could be different. So credit sale and debtors may be same, but they could be different also. Yep. Any other question? Okay, fine. So just like you did the calculation for your debtors collection period and you linked it to debtors turnover ratio, on similar lines, if you look at creditors payment period, what do you want? You want the creditors payment period to be high because you want to delay the payment to your supplier, which means you want your creditors turnover ratio to be low. So as a company, you want your creditors turnover to be low. Now, see, it's not necessary that I'll calculate my debtors only at the end of the year. I could calculate my debtors at the end of every day. So let's say I'll tell you, or maybe on a weekly basis or a monthly basis. So let's say if I'm calculating or I'm making the P&L for the month of April and a balance sheet as on 30th of April. So my credit sale for the month of April will be 100 crores. But let's say in the month of April, you are my customer and you paid 20 crores. So as on 30th of April, when I look at my debtor balance will not be 100 crore. My debtor balance will be 100 minus the 20 crores that I've received from you, which will be 80 crores. So if I don't get anything from you or there is no bad debt, then in that case, your credit sale and debtors will be the same. But if something has happened in the middle, then the figures could be different. Similarly, on the same lines, you could do the calculation for inventory holding period. So if I'm looking at inventory holding period, how will I calculate inventory holding period? I'll take this 365 and I'll divide it by inventory turnover ratio. For calculating inventory turnover ratio, I'll take numerator as cost of goods sold and I'll divide it by the inventory or stock, whatever you want to call it. So inventory holding period will be 365 upon inventory turnover ratio. For calculating the inventory turnover ratio, take your COGS and divide it by inventory. Any doubt with this, anyone? And again, you want your inventory holding period to be low, which means you want your inventory turnover ratio to be high. So again, let's say if you are a company like Shoppers Stop or Zara's or any retail outlet, you don't want that inventory to be sitting on the shelf for, let's say, more than a week or more than 10 days or 15 days. So you want your inventory holding period to be low, which means you're telling me that you want your inventory to turn around. Your inventory turnover ratio should be high. You want your inventory to turn around quickly. You don't want your inventory to turn around, let's say, only 2 times or 3 times in a year. You would prefer your inventory to turn around 40, 50, 60, 100 times in a year. So any doubt with fixed asset turnover, total asset turnover, debtors turnover, inventory turnover, creditors turnover, and we also linked it with debtors collection, inventory holding, and creditors payment period. Yep. Any doubt with this? Again, from an exam point of view, yeah. So that's your debtors collection period. Yeah, Yunus. Okay. Got a question from Satish. Low inventory turnover is good. Again, Satish, low inventory turnover, which means you're telling me that your inventory is selling off, let's say, only 2 to 3 times in a year. So let's say I've got two retail companies, A and B. Okay, so I've got two retail companies. A is selling off inventory only 3 times in a year, whereas B is selling inventory 30 times in a year. So if I want to calculate my inventory holding period, what will happen? And let's assume I've got 360 days in a year for ease of calculation. So if I have an inventory holding period will be 360 upon 3, which means over here I'm holding inventory for 120 days. But in the second case, I'm holding inventory for only 12 days. Which one is better? You want to keep the inventory for 12 days in the go down on the shelf, or you want to keep the inventory in the go down on the shelf for 120 days before it is sold? Of course, B. In the async, they would have used DSO, DPO, and DIO. Fine. So that's DSO is for sales, DPO is for payables, and DIO is for inventory. Yeah, if I'm not wrong. So again, see, different people will give different names. So over here, I'm using debtors collection period, but I know that some people will also say it as your DSO. Inventory holding period is DIO. So again, it's just that the nomenclature changes, but the meaning is the same. Meaning doesn't change. Now, one thing that I just wanted to share is that from an exam point of view, when you're calculating, let's say, your operating cycle time, cash conversion cycle. So when you get your debtors collection period, your creditors payment period, and your inventory holding period. So you'll take your inventory holding period, you'll add your debtors collection period, you'll deduct your creditors payment period, and you'll get your cash conversion cycle or your operating cycle time. For example, let's say inventory holding period is 4 months. Debtors collection period is 3 months. And creditors payment period is, let's say, 2 months. So I'll take 4 plus 3, that's 7, minus 2. I'll write an answer of 5 months. Okay. So please do this in the exam. But again, there is a big flaw in this. Logically, it doesn't make this. I mean, in real life, you shouldn't be adding this, and deducting this. Any guesses why it doesn't make sense? What could be the problem here? I'm taking 4 months of inventory holding period plus 3 months of debtors collection period minus 2 months of creditors payment period. I get 5. No, I mean, this is, see, whatever you're doing is, this is average. So you're saying that on an average, inventory holding period is 4 months. Huh? So let's say there could be months where you hold the inventory for 3 months. There could be months where you hold it for 5 months. But I'm saying on an average, inventory holding period is 4 months. Similarly, for debtors, there could be days when the customer makes a payment in 10 days. There could be times when the customer makes a payment in 200 days. But I'm saying on an average, my debtors collection period is 3 months. So that is fine. So I'm not talking about exact date period. No, that's an average. That's fine. That's not an issue. But I'm still saying I just cannot directly add and deduct this. There is a flaw over here, and it's a serious flaw, which most of the books don't recognize and they don't accept it. Interest cost, okay, fine. What you're talking about is opportunity cost, okay, fine. But then, I mean, I'm not looking at opportunity cost over here. I'm just calculating my cash conversion cycle over here. So I'm not concerned with opportunity cost or the money blocked. I'm not capturing that. That I'll look at whether I should give a credit period of 3 months to my customer or should I give a credit period of 2 months. So that is something that the marketing team will decide. And of course, that at that time, they'll of course look at the opportunity cost, the interest cost and everything. That's for sure. But if I'm just calculating my cash conversion cycle, I cannot directly add and deduct this. The problem is, when you calculate debtors collection period, this is 3 months of sale. Okay, and that to credit sale, because how do you calculate your debtors collection period? Your debtors collection period was what? 360 or 365 upon debtors turnover ratio. And debtors turnover ratio was nothing but credit sales upon average debtors, which means whenever you calculate your debtors collection period, it is based on credit sales, which means this is nothing but 3 months of sale. When you're calculating credit purchase, it is 2 months of purchase cost. And when you're calculating inventory holding period, that is also cost, but that is 4 months of cost of goods sold. I can't add and deduct something which is in terms of sale, something which is in terms of purchase, and something which is in terms of cost of goods sold. It is like saying, can I add 4 kgs of apple with, let's say, 6 kgs of banana and say it is 10 kgs? It is 10 kgs, but it consists of 4 kgs of apple and 6 kgs of banana. Similarly, over here, 4 plus 3 minus 2 is 5 months. But what are these 5 months? These 5 months are what? Are these 5 months of cost of goods sold? Are these 5 months of sale? Are these 5 months of purchase? No. You have clubbed everything together and then you're saying it is 5 months. So typically, what a banker will do is a banker will not look at this number when you give this number to them. What they'll do is they'll convert everything into one common base. So generally what they do is they convert everything in terms of sale. So they'll say, okay, let's convert inventory holding period and creditors payment period in terms of sale. So this is already in terms of sale, which is 3 months of sale. So they'll say, okay, 4 months of cost of goods sold. How many months of sale is it? Again, I'm not getting into the nitty-gritties of how they do it, but I'm saying, okay, this is typically something that happens. So they'll say, okay, 4 months of cost of goods sold is, let's say, 2.5 months of sale. Then 2 months of purchase is how many months of sale? Let's say it is half month of sale. Now I can add and deduct because the base is the same. Because this is 2.5 months of sale, this is 3 months of sale, this is half month of sale. So when I get my cash conversion cycle over here, I will get 2.5 plus 3, that's 5.5 minus 0.5. I'll get 5 months of sale. But this 5 month, I had no idea whether it is COGS or whether it is sale or whether it is purchase or it's combination. It's a combination. So typically in real life, this is what will happen and not this. But for the exam, please do this. Don't do this. For the exam, please stick to this. No, again, see, tell me, can you add 10 kgs of wood with 5 kgs of apple and then say you've got 15 kgs? You've got 15 kgs worth of item But then 10 kgs is a separate item, which is wood, 5 kgs is apples. You can't club it together and then say, oh, I've got 15 kgs. You can't say I've got 15 kgs of fruits. No. Because see, typically, why do you calculate a cash conversion cycle? A cash conversion cycle is used for going to a bank and then saying, tell me how much short-term loan can you give me? So this is typically used when, let's say, you want to go for a CC limit or an OD limit or a short-term loan. So banker will say, okay, your money is getting blocked for 5 months, and accordingly, I will try to give you or sanction the loan. But this is what this is neither 5 months of cost of goods sold, this is neither 5 months of sale, this is neither 5 months of purchase. But here, when I'm doing the calculation, this is 5 months of purchase. So now what the banker will do is the banker will calculate what's your sale per month. So let's say your sale per month is 10 crores. And then he'll say, okay, your cash conversion cycle is 5 months of sale, which means money blocked is how much? 5 months into 10 crores, which is 50 crores. I can give you a maximum short-term loan of 50 crores. Just a hypothetical example. So this is why banks will not prefer this. When you give them this calculation, they'll say, okay, you give it to us, we'll do whatever we want at the back end. And they'll typically convert it to one common base and then come up with a number. So they don't go with this logic, they'll go with this logic. Okay, exam, please do this only. Huh? Don't try to be over smart. Okay, then let's look at DuPont. Any questions on this before we look at DuPont? Okay, then let's look at DuPont analysis. Now, DuPont analysis is nothing but an extension of return on equity. So how do you calculate your return on equity? Return on equity is the return that you're generating for your equity shareholders. So return on equity is nothing but your net profit upon your shareholders fund into 100. So this is how you basically calculate your return on equity. Now, around 100 years back, to be precise, around 102 years back, a company named DuPont in the US, they said, okay, is there a way in which I can bifurcate this return on equity and look at the different factors which influence the return on equity? So in your async content, what you have is basically a 3-factor DuPont analysis, where they've said that return on equity depends on 3 factors. So DuPont went ahead and they came up with 5 factors also, but then that's not there in your syllabus. What you have is 3 factors. They said return on equity can be influenced by 3 things. Number 1, how profitable you are. Number 2, how efficient you are. And number 3, how much debt you have taken. So if you're a profitable entity, at the same time you're running a business efficiently, and you also take some debt, you can increase your return for the equity shareholders. So it's a multiplier. So you'll take profitability into efficiency into debt. Now, which profit? This profit is nothing but your net profit ratio. Which efficiency over here? This efficiency is nothing but your total asset turnover ratio. And this debt, it's captured by something which is known as equity multiplier. So this is a new term, we'll discuss it. So if you take your net profit ratio, multiply it with the total asset turnover ratio, and multiply it with equity multiplier, you will get the same return on equity. Why? Expand this. How do you calculate net profit ratio? Net profit upon sales into 100. How do you calculate total asset turnover ratio? Sales upon total assets. So sales and sales will nullify each other. And how do you calculate equity multiplier? Equity multiplier, I'll take total assets in the numerator. So again, numerator and this each other. And equity multiplier is nothing but total assets upon shareholders fund. So again, if I look at finally what I'm getting net profit, which is this. I'm getting into 100, which is this. And I'm getting a denominator of shareholders fund, which is this. So return on equity depends on 3 factors. If you're looking at a 3-factor DuPont analysis, one is your profitability, which gets captured by net profit ratio. One is efficiency, which gets captured by your total asset turnover ratio. and one is debt, which gets captured by equity multiplier. So equity multiplier will tell you whether you have too much of debt or you have little bit of debt. Any doubt with the DuPont analysis? And if you're a fundamentally strong company, should be focusing on the first two, which is profitability and efficiency to increase the ROE. So of course, you can take debt also and increase the ROE. But let's say if I'm a fundamentally strong company, then I should be a profitable entity and I should be using my assets efficiently. Along with that, if I take debt, that is fine. But on the contrary, if I have a company which has very low profitability, which is not at all efficient, but has taken too much of debt, that company can also increase the return for the equity shareholders. But then what the company is doing is the company is taking too much of risk. And you're telling me that fundamentally the company is not that great because company is not able to manage its cost, therefore the profits are low. The company is not managing the assets efficiently, the efficiency is low, but because they have taken debt, they are able to increase the return on equity. So if I'm looking at two companies, I'll prefer a company which has more profit, which is more efficient compared to the company which has taken more debt, both of them having the same return on equity. Total asset will include all types of assets, everything. Total asset means all assets, tangible, intangible, current, everything. Yeah, this will be shown in percentage because you're multiplying it with 100, so it will be shown in percentage. So finally, your return on equity, using the DuPont, will also come in percentage. So it will come as, let's say, 30%, 20%, 10%, whatever it is. Yep. Any questions on DuPont? Okay, then let's look at, is equity multiplier the same as leverage? Some people call it as financial leverage also. So in some books, they call it as financial leverage. In some books, they call it as equity multiplier. And like you said, in some books, they call it as a leverage ratio. Who's DuPont? DuPont is the name of a company which invented this. So it was named after that company, DuPont. It's a US-based company. Any questions on this before, let's say, we could look at a few questions on, let's say, DuPont, and maybe a few small questions where we just do simple calculations and then look at a big caselet on ratios. And then we can take a break. Okay, let's look at the first question, which is on DuPont. So let's say I've got this question. It says XYZ Limited has maintained a stable and relatively high return on equity of 18% over the last 3 years. So the return on equity is 18%. Use the traditional DuPont analysis to decompose this ROE into the 3 components, which means you have to use the 3-factor DuPont analysis and comment on the trends on the company's performance. And they've given you the data for last 3 years, 17, 18, 18, 19, 19, 20. They've given you net profit, revenue, average equity, average asset. So let's do the calculation parallelly. So I'll do it along with you. Okay. So let's do it. So I'll just extend these lines. So let's say the first thing that we need to calculate is the net profit ratio. So let's calculate the net profit ratio. So using this data, how will you calculate the net profit ratio for 17-18? If you have this data, how will you calculate the net profit ratio for 17-18? Anyone? Net profit upon revenue. So net profit ratio is what? Net profit upon sales. So I'll take this 21.5. I'll divide it by 305. So I'll take 21.5 divided by 305. Somebody just calculate and tell me how much is 21.5 divided by 305. So that will give me the net profit ratio. Yep. How much is the net profit ratio that you're getting? 0.07, multiply it with 100%, 100, so you'll get 7%. So that's in percentage, 7%. Let's keep it up to 2 decimals, huh? Because the numbers could be very close. So up to 2 decimals. So how much are you getting? Exact 7 or something else? $7.05. Okay. So I'm getting 7.05. Okay. Are you getting, so fine, 7.05, 7.04 is fine. Similarly, do the calculation for 1819 for the net profit ratio and 1920 for the net profit ratio, and tell me how much are you getting? The net profit ratio for 1819 and 1920. So again, for over here, I'll take 22.3 divided by 350, here 21.9 by 410. So you're getting 1819, you're getting how much? 8.92 or 6.37. I've got two answers. Take 22.3 divided by 350. 6.37. Okay, so I'll go with 6.37. And then similarly for 1920, take 21.9 divided by 410. So okay, so you're getting 5.34. So any questions on the net profit ratio, anyone? So net profit ratio is net profit upon sales. In this case, sales is written as revenue. So take those numbers, you calculate the net profit ratio. Then the next number that we need is the total asset turnover ratio. So how will you calculate the total asset turnover ratio? Anyone? For 17, 18, which numbers will I take? Total asset turnover ratio. Total asset turnover ratio is nothing but sales upon total assets. So you'll take 305 divided by 230. How much are you getting? Anyone? And again, take up to 2 decimals. $1.32. Okay. Similarly, do the calculation for 1819 and 1920. 1.32, 1.33 is fine. How much are you getting for 1819? Okay, 1.2. And then last year you're saying it's 1.17. Others see if you're getting numbers which are close to it. Huh? So 1.17 could be 1.18, 1.16, fine, but that 1.17 should not become 1.27. Yep, so you're getting numbers close to this 1.32, 1.2, 1.17. Okay. So we've got 2, which is net profit ratio, asset turnover ratio, and what we need is now equity multiplier. So how will you calculate your equity multiplier now? Which all numbers will you take to calculate the equity multiplier? Yep, you'll take asset upon equity. So you'll take this and this. So calculate and tell me what's your equity multiplier for 1718. Okay, I've got an answer of 1.93. Then anyone who's got it for 1819? Okay, 2.33, and then for the next one, 2.78. Numbers close to this are fine. Okay. Finally, multiply the numbers and get your ROE, return on equity. Because what is return on equity? Net profit ratio into asset turnover ratio into equity multiplier. So multiply these 3 numbers you'll get the ROE for 17-18. Multiply the next three numbers, you'll get the ROE for 18-19, and multiply the next three, you'll get it for 19-20. Just calculate and tell me how much are you getting. Okay. No decimals, huh? Because like I said, the numbers could be close. So calculate up to 2 decimals for each and tell me. 18.07, then 17.98 and 17.38. Fine. So net profit ratio is in percentage, return on equity again in percentage. Fine. Any questions still here as far as the calculation is concerned before we look at what is the interpretation? Okay, let's look at it. Now let's look at the net profit ratio. If you look at your net profit ratio, it's on a declining trend. From 7%, it went to 6, and then it moved to 5, which means your profitability is going down. You're not able to control the cost, which again tells me that you are inefficient as far as cost management is concerned. Then let's look at asset turnover ratio. Asset turnover ratio tells you how efficiently you're using your assets, because it tells you for every 1 rupee of asset that you have, how much is the sale that you're generating. So in 17-18, for every 1 rupee of asset that you had, you're generating a sale of 1.32. Then it went to 1.2, and then it became even worse. It became 1.17. So again, if I look at my asset turnover ratio, it is going down. Net profit ratio, it is going down. But look at your equity multiplier. Equity multiplier talks about leverage or debt which is there in the company. What is happening? Company has been taking and increasing debt, because equity multiplier from 1.93 has gone to 2.33 and then 2.78. So the company is increasing the risk and they're taking debt more and more. Now, fundamentally, the company is not doing well because the profitability is going down, cost is out of control, efficiency is gone for a toss, but still you're able to generate good returns for your shareholders, and you're giving them a return of close to 17.5%, 18%. And that is because you've got too much exposed to debt. So as far as I'm concerned, I would say, okay, the company is not on the right track. The company is fundamentally becoming weak, but still it's able to give decent returns to the shareholders by taking debt. And debt is like a double-edged sword. If the economy is doing well, your company is doing well, and you take debt, fine. You'll be able to give returns to your shareholders. You'll be able to pay back the money to your lender. Everything falls in place. But if it turns, there's recession, your company is not doing well, your company starts losing out on the market share, your sales dwindle, ultimately what will happen is you will start defaulting, the banker will drag you to the court, and finally you'll get liquidated. So it's a double-edged sword, and that is why you call it as a leverage, because it acts as a lever. It gives you multiplier impact or multiplier effect. So again, fundamentally it's not a great company, but still the company is able to give you returns of close to 18%. Any doubt on this question which deals with DuPont analysis? Yep. Any doubt with this, anyone? Okay. Then let's look at two small questions, and then if you want, we can take a break, and then we can come back to the big question. Or if you feel that no, you want to finish off the big question also, then we'll finish that off also. So let's look at this question. So let's look at the first one, and I want you all to try it. Abid, just we'll finish up these two small questions. Maybe this will take like 5 minutes, and then we'll take a break. Okay, let's look at the first one. This basically deals with the current ratio, quick ratio. Okay, so let's look at the first one. The ratio of current assets, and they're saying current asset is 6 lakh to current liability is 4 lakh, is 1.5:1. Now, how do you calculate your current ratio? Current ratio is nothing but current asset upon current liability. So current ratio is nothing but current asset upon current liability. So you've taken 6 lakhs, you divide it by 4 lakhs, you get 1.5:1. They're saying the accountant of the firm is interested in maintaining a current ratio of 2:1. So the company doesn't want a current ratio of 1.5. They want to increase it to 2:1. And how do they intend to do it? By paying off a part of the current liability. The question is, calculate the amount of current liability that should be paid off. Yeah, try and tell me what's the answer that you're getting. What is the amount of current liability that you will pay off so that you can maintain a ratio of 2:1? Okay, I've got answers of 1 lakh, 1 lakh, 2 lakh. Yep. Anyone else? Ankit has given 1 lakh, Satish 1 lakh, Jyotishman again 1 lakh, Paravela 2 lakhs, Vibhor 1 lakh. So are we getting only 1 lakh, 2 lakh, or someone else getting a different answer? Okay, let's look at it. Let's see what's the correct answer. Correct answer is 2 lakhs and not 1 lakh. Why? I'm saying calculate the amount of current liability that should be paid. When you pay off a current liability, let's say this entire 4 lakh is creditor. When you pay some amount to your creditor, will it not impact your current asset, or your current asset will remain the same? Your current asset will also change, because when you pay money to your supplier, to your vendor, cash will decrease. Cash is a current asset. So if you say that initially you had numbers of 6 and 4 and you want to reduce and repay off the liability by 1 lakh, you're paying 1 lakh to your supplier, which means your cash balance will also go down by 1 lakh, which means it will become 5/3, and 5/3 is not equal to 2:1. But if you take, let's say, something like 2 lakhs, then what will happen? I'll have 6/4, which is my initial number. Then I'm saying, okay, I'll pay off 2 lakhs to my supplier. And if I pay 2 lakhs to my supplier, my cash balance will also go down by 2 lakhs. So numerator now becomes 4 lakhs. Denominator is 2 lakhs. I will get a ratio of 2. Any doubt with the first question? Anyone? Yep. So it's not 1 lakh, but it's 2 lakhs. Any doubt with this? So it's a pretty straightforward question. If you just look it properly, you'll be able to do it. Okay, Jyoti. Jyoti, what's the doubt? Where are you struggling? Which part? Can you just let me know? How is it 2? Fine. Okay, let's do it. I've got current ratio of 6 lakh by 4 lakh, which as of now is 1.5, which is this number. Now the accountant is saying he wants to pay off some amount of current liability, which means whatever current liability you have, some amount is to be paid. So let's say this 4 lakhs is creditor. 4 lakh is your supplier. You want to pay some amount to your supplier. Let's assume hypothetically you are paying X rupees. So if you pay X rupees, what will be your new creditor balance? 4 lakh minus X. But at the same time, again, I mean, I'm not doing it randomly saying that, okay, try with 1 lakh, try with 2 lakh. No, you try it with X and Y, you'll get the answer. You'll do it. So this is how you will do it. So you'll say, okay, let's say I'm paying X rupees to my supplier or to my vendor. So my liabilities will go down by X. So if my liabilities are going down by X and I'm making a payment, my cash balance will also go down, and that will also go down by X. So if I pay 10,000 to my supplier, my liabilities will go down by X. At the same time, my current asset will also go down by the same amount, which is X. So what will be the numerator now? Numerator will be 6 lakh minus X. So what is my equation now? 6 lakh minus X upon 4 lakh minus X, and this will be equal to 2. So now if you cross multiply, you will get X as 2 lakhs. Any doubt with this? So again, I'm not just randomly assuming start with half a lakh, 20,000, 20,000. No, you assume any number X, Y, Z, whatever it is, and say, okay, if this is going down by X, this will also go down by X. And finally, I'll get a ratio of 2, do a cross multiplication. X will come as 2 lakhs. So X is the amount by which you're paying it off. So that's the answer. Liabilities will go down by 2 lakhs. Now try the second one and then we'll take a break. They're saying current assets to current liability of a firm is 8 lakh to 3 lakh. Accountant of the firm wishes the current ratio to be 2:1 by acquiring current assets on credit. Calculate the amount of current assets to be purchased on credit. Okay, I've got 2 lakh, 2 lakh, Prithpal, 2 lakh, current assets to be purchased, 2 lakhs, 2 lakh. Fine. The correct answer is 2 lakhs. So you're struggling with the first one, but now second one is easy. Fine. So second one again, what will I do? I'll take 8 lakh by 3. So that's my existing situation. And I want the ratio to be 2:1. And I want to acquire an asset. And how do I acquire that asset? I am purchasing it on credit. So let's say I go and buy current assets. So current assets will go up by X. But I'm buying these assets on credit, which means my current liability will also go up by X. And I'm saying this should equal to 2. So 8 plus X divided by 3 plus X equated to 2, you'll get your answer. Any doubt with this? Anyone? Otherwise, we take a break. Yeah. Any questions on this? Anyone? Yeah, calculators are definitely there. In fact, I'm not sure whether the paper is Excel based or not. If it is Excel based, then you can do everything on Excel only. Or if it's not an Excel based, then of course calculator will be there. So calculator, I think there's an on-screen calculator. So that will be allowed. Okay. Prithpal is saying if I buy current asset with cash, which means it is not a credit purchase, then what will happen if it's a cash purchase? Yep. So what will happen? Anyone? If he's saying no, if I don't want to do a credit purchase, but I want to do a cash purchase, so what will happen? What is my existing situation? 8 lakh by 3 lakh. I go to your shop, I buy goods worth X and I pay X. So cash will go down, but another current asset will go up, which means ultimately I'll still end up having the same ratio, which is 8/3. Yep. You'll have the same ratio. Ratio will not change if you buy it on cash. Yep. Any further questions? Otherwise, we go and take a break. Yep. Any questions till now? Maybe on DuPont or turnover? Okay. And let's take a break. Let's resume at 8:30. Okay. So we'll resume at 8:30. Let's take a break. Okay, let's resume. Let's look at one more question, and then we'll go back to the main question on ratios. So let's look at this question. This is again a small question. Let's look at this. It's saying a business has a current ratio of 4:1, quick ratio, which is nothing but your liquid ratio or acid test ratio, different names given. So either you call it as a quick ratio or acid test ratio or liquid ratio, 1.2:1. Working capital is given as 1,80,000. Now, what is working capital? Can anyone tell me what's working capital? Yep. Anyone from the batch? What do you mean by working capital? No, working capital is not operational expense. Inventory, it's a part of working capital, but it's not working capital. Working capital is typically, let's say, if I'm looking at it from the point of view of, let's say, balance sheet, working capital is nothing but your current asset minus current liability. Okay. So working capital is the assets and the liabilities which are needed for your day-to-day operational activities. So it's nothing but current asset minus current liability. So they've given you the current ratio. Current ratio is given as 4:1. Quick ratio is given as 1.2:1. Working capital is given as 1,80,000. And they're saying calculate total current asset and stock. And they've said that there is no prepaid expense. So let's try this. My current ratio is 4:1. So how do I calculate my current ratio? Current ratio is nothing but current asset upon current liability. And they're saying this is 4:1, which means if I cross multiply, I'll get current assets is equal to 4 times current liabilities. Any doubt with this? Current asset is 4 times current liabilities. Okay, fine. Then let's look at quick ratio. Anyone who can tell me how do you calculate quick ratio or liquid ratio or acid test ratio? We did this in the last class. How do you calculate quick ratio, liquid ratio, acid test ratio? Current assets minus stock. Now again, typically you should also be excluding prepaid expense. And then you'll get divided by current liability. That's your quick ratio. So if you look at quick ratio is basically current assets minus stock minus prepaid expense. So you reduce your stock or inventory because it's a slow moving, it will not get converted into cash quickly. Prepaid expense, you already spent the money, you will not get back the money. So this numerator that you get over here, some people also call it as quick asset. So quick assets are assets which can get converted into cash quickly. So you remove stock, prepaid expense from your current assets. So you get quick assets in the numerator and divided by current liabilities. That will give you the quick ratio. The question says there are no prepaid expense. If there are no prepaid expense, which means I can exclude this. So my formula typically becomes current asset minus stock upon current liability. And this they're saying is equal to 1.2. At the same time, they're also saying working capital is 1,80,000 and working capital is nothing but current asset minus current liability. So working capital they're saying is 1,80,000. Working capital is nothing but current asset minus current liability, and that is 1,80,000. Now I already know that my current asset is 4 times current liability. So instead of writing current assets over here, can I replace it and say that it is the same as 4 current liability? So can I write 4 current liability over here? So 4 current liability, I'll reduce the current liability. I'll get 1,80,000. Now if you solve it, you'll get 3 current liability is 180. Finally, 1,80,000 divided by 3, you get your current liability. Current liability will come as 1,80,000 by 3, that's 60,000. Any doubt with the current liability of 60,000? Yep. Any questions still here? Current liability of 60,000. Now, if your current liability is 60,000 and your current assets are 4 times the current liability, so how much is your current asset? It will be 60,000 into 4, which is 2,40,000. So current asset becomes 2,40,000. Now going back to the quick ratio, I know my current assets. Current assets are 2,40,000. So I know this number. I know my current liability, which is 60,000. I'll solve it. I'll get my stock. So I'll solve it. I'll get 2,40,000 minus stock divided by 60,000 is equal to 1.2. So how much is the stock that you're getting? Anyone? Subramanya, which part do you want me to repeat? Four times. Okay, this 4 times, initial one. Okay, let's look at it. They're saying a business has a current ratio of 4:1. So how do you calculate current ratio? Current ratio is nothing but current asset upon current liability. Any questions still here? Current ratio is current asset upon current liability. And the question says it is 4, which means I can easily say that current asset upon current liability is equal to 4. And if I cross multiply, so if I multiply these two, then what will I get? I'll get current asset is 4 times current liability. So my current assets are 4 times my current liability. So if current asset is 1, current liability is 4. No, reverse. If current liability is 1, current asset is 4. So if current liability is 1, current asset is 4. I'm saying my current assets are 4 times my current liability. So whatever is my current liability, if my current liability is X, current asset is 4X. If current liability is Y, my current asset is 4Y. Yep. Any questions on this? So you get current assets of 2,40,000, current liability of 60, and stock of 1,68,000. Any doubt with this, anyone? Any questions? So we had to calculate total current asset and stock. We've calculated total current asset. We also know the stock. We also calculated the current liability. Okay. Yep. Can we move to the caselet on ratios? Or anyone still working on this? Okay. Then let's move to the caselet. Okay. Let's look at the caselet. So if you look at this caselet, they've given you the balance sheet of Amar Limited as on 31st of March. So they've given you the liabilities, the respective amount. They've given you the asset, the respective amount. And finally, the balance sheet total is also given. So that's your balance sheet. So you have equity share capital, you've got retained earnings. That's nothing but your reserves and surplus. They've got debentures, creditors, bills payable, other current liabilities. Then they've got land and building, cash, debtors, stock. Then they've given you the income statement, which is the P&L account. So you've got credit sales, then you've got cash sales, and then they're saying, okay, we'll reduce cost of goods sold. So cost of goods sold consists of the material cost, the wage cost, the factory overheads put together. That's 1,62,36,000. If you reduce it from the sales, you get your gross profit. So gross profit is given as 57,64,000. Then you reduce your other costs, which is selling and distribution cost, admin cost. Finally, what you get is EBIT. So you got an EBIT of 11 lakh 8,000. Reduce your interest, get your PBT. Tax rate is given as 50%. You'll get your profit after tax. Any doubt with the data that's given in the question? They've given you the balance sheet and the income statement. Okay, then let's move further. Now what they're saying is, they've given you some data for the industry that this company belongs to. They've calculated the asset test ratio. The asset test ratio for the industry is 1.5. Asset test ratio is a quick ratio, liquid ratio. Then they've calculated the debtors turnover ratio. So they're saying debtors turn around 5 times. So this is what is happening in the industry. So this is the data for my peers, my competitors. Then inventory holding period is given as 90 days. So my competitors hold inventory for 90 days. The total asset turnover ratio for my competitors is 2. Net profit ratio for my peers is 3.5%. They generate a net return on net worth of 10.5%. The debt to asset ratio is 60%. And interest coverage ratio is 8. Please zoom in. Okay. Is it better now, Abid? Okay. So they've given all this data and now they're saying compute the above ratios for your company, which is Amar Limited, and provide your comments comparing the ratios with the industry norms. So the first thing that we have to do is we have to calculate these ratios for our company. So we'll calculate asset test ratio, debtors turnover ratio, inventory holding period, total asset turnover ratio, net profit ratio, return on net worth, debt to asset ratio, interest coverage ratio for our company. Then once we get the ratios for a company, we'll compare them with the industry ratios. And then we'll say, is it good or bad? Where do you think the company is lagging or there's some scope of improvement? That's the first part. Second part, calculate the operating cycle time and comment on the operating cycle time of the company if the industry norm is 38 days. So they've already done the calculation for the operating cycle time of your peers, and that comes to 38 days. You need to calculate the operating cycle time for your company, compare it with 38 days, and then give your views on that. So let's do the first one. Let's calculate the acid test ratio. Now, how do you calculate acid test ratio? That's your quick ratio. We just discussed it. Anyone? How do you calculate acid test ratio? Or the quick ratio? Asset test ratio is nothing but your current assets minus stock minus prepaid expense upon current liability. In this case, I don't have any prepaid expense or anything. So one thing is I first take all my assets, current assets, and then I reduce stock and prepaid expense. Or alternatively, what I do is I just look at my quick current assets. So if I look at my quick current assets consist of cash and debtors. So I'll take cash and debtors. So that will come in the numerator and I'll divide it by my current liability. My current liability will consist of creditors, bills payable, and other current liabilities. So take cash and debtors in the numerator, creditors, bills payable, current liability in the denominator. Finally, you'll get a quick ratio. Just check and see if you're getting a quick ratio of 1. See if you're getting 1. Yep, your quick ratio should be 1. Any questions on the quick ratio? So need the values. Excel is already shared with you. You must be having this Excel. Yep. Others, do you have this Excel with you? Because this was shared initially only. So I'm sure the team would have shared it with you. Yep, others have it. Okay, fine. So take your cash, take your debtors, add it up. That's your numerator. Take your creditors, bills payable, other current liabilities. That's your denominator. Just check and see if you're getting a ratio of 1. Getting it? Okay, fine. So the asset test ratio, the quick ratio, the liquid ratio for the company is 1. Why didn't we subtract stock? Okay, question is why didn't we subtract stock? I will subtract stock if I take all my current assets, which means I'll take cash, debtors, and stock, and then I'll reduce stock. So the question is, why should I waste time? So I'll first take cash, add debtors, add stock, and then again I'll reduce stock. So instead of doing that, I'm saying, okay, just take cash, just take debtors, you'll get the same answer. If you want to do it like that, take it. So you'll first take all your current assets and then remove stock and prepaid expense. Okay. Now let's go back to the solution. So for my company, the asset test ratio is 1, which talks about the liquidity position of the company. That in the short term, well, will I be in a position to fulfill my commitments on time? Can I make the payment to my supplier on time? Or I could, let's say, default, something of that could happen. When I compare it to the industry norm is 1.5, which means compared to the industry, compared to my peers, I have some liquidity issues. There could be a cash crunch. I may default. I'm not saying that you will default, but you could have some short-term liquidity issues. So, I mean, you are lagging behind as far as your peers are concerned. Any doubt with the asset test ratio, the first one, before we look at the next ratio? Okay. Then let's look at the next ratio. The next ratio that we need to calculate is your debtors turnover ratio, receivables turnover ratio. So let's calculate debtors turnover ratio. How do we calculate debtors turnover ratio? We just discussed it today. Debtors turnover ratio is nothing but credit sale upon accounts receivable. Okay. So let's look at credit sale. Where is my credit sale? My credit sale is here. So I'll not take total sale. I'll just take the credit sale. Then let's look at account receivable. Accounts receivable will consist of your debtors and bills receivable. In this question, I just have debtors. So I'll take this. So take your credit sale, take your debtors, you'll get your debtors turnover ratio. So your debtors turnover ratio comes to 9.1. Yeah, 9.09. So that's fine. So if I extend to 2 decimals, I should also be getting 9.09. Yeah. Yep. Others are getting 9.09. Anyone struggling with this 9.09? The debtors turnover ratio, credit sales upon average receivables. In this case, we just have debtors, we don't have bills receivable. 9.09. Fine. So now if I look at debtors turnover ratio, what does debtors turnover ratio? Debtors turnover ratio tells me how many times my debtors are turning or churning around in a year. So as far as my company is concerned, I turn them around 9 times. Industry, my peers are able to turn them around only 5 times. Now using the debtors turnover ratio, I've calculated the debtors collection period. Now, how do you calculate your debtors collection period using your debtors turnover ratio? Again, we just discussed it today. So debtors collection period will be what? 365 upon debtors turnover ratio. So I'll take 365 and I'll divide it by 9.5. Finally, I'll get my debtors collection period. So for my company, the debtors collection period is 40 days, which means when I sell goods, on an average, my customer makes a payment within 40 days. But when I look at the industry, my peers, when they make a sale, they get the money in 73 days. So this is an advantage for me. I sell the goods, I get the money back quickly. My peers get the money back in 73 days. So any doubt with debtors turnover or debtors collection period? Okay. Then let's look at the next ratio. Next ratio is, I think, Which one is it? Let's go back to the question. Inventory holding period. So I need to calculate inventory holding period. Now, how do I calculate inventory holding period? Inventory holding period will be nothing but 365 divided by inventory turnover ratio. And how do you calculate inventory turnover ratio? Inventory turnover ratio is nothing but COGS upon inventory or stock. So 365 in the numerator and then divided by COGS and stock. So let's look at COGS. Where is my COGS? COGS is given here. So that's my COGS. So this is my COGS, 1,62,36,000. And inventory will be there in the balance sheet. Inventory is here. So this is my inventory. So I'll take 365 and I'll divide it by the inventory turnover ratio, which is COGS, which is this number divided by this number. I'll get my inventory holding period. So what's the inventory holding period that you people are getting? 148.37 days. Let's check it. Yeah. So you're getting 148.37 days. So that's fine. So again, if I expand it to 2 decimal places, I should be getting the same number. Yeah. Okay, which means you hold the inventory in the go down for 148 days before you are able to finally sell it off. But if you look at your peers are able to sell off the inventory in flat 90 days. So you hold it for approximately 5 months. Peers are able to sell it off in 3 months. This is a big disadvantage for you because it gives you an indication that maybe your stock or inventory is a slow moving stock. People don't like your products. Either the pricing is more, the quality is not that great. There is some problem somewhere. Either it's the pricing issue or an issue with the product. So again, the team will have to sit together, be the marketing team, be the production team, the quality department team, R&D team, and then they'll have to figure out why this is happening. What's the problem? Why is it that our inventory is sold off in 5 months, but the peers and the competitors sell off in 3 months? Any doubt with inventory turnover ratio? Anyone? Okay. And let's look at the next one. Next one is I need to calculate the total asset turnover ratio. So total asset turnover ratio for the peers is 2. How do you calculate? Okay, I got a question. What is factory overhead? Okay, anyone who can tell me what is factory overhead? This question is with respect to this. What is a factory overhead? Anyone? Factory overhead. Overhead, as the name suggests, it's an indirect cost. So it's a cost which you cannot directly allocate it to a product, but it's incurred and that cost is split amongst the number of units. For example, rent, electricity bill, security guards, costs, so on and so forth. So I cannot directly say that, okay, this security guard, this amount will go to this particular unit. I can't do that. So that's a factory overhead. So indirect cost incurred in the factory is known as factory overhead. Okay, so again, going back to the total asset turnover ratio, total asset turnover ratio is nothing but sales upon total asset. So when I'm looking at total asset turnover ratio, it's sales upon total assets. So I'll take all sales and I'll take total assets. So I'll take all sales and I'll take total assets. I'll divide the two. I'll get my total asset turnover ratio. So Ankit has said that it's 1.43. Let's see if it's 1.43. Let's just check. Yeah, it's 1.43. So you should be getting a total asset turnover ratio of 1.43. What does this tell you? This tells you that for every 1 rupee of asset that you have, you generate a sale of 1.43. But what about your competitors? For every 1 rupee of asset that they have, they generate a sale of 2 rupees. So if both of you are in the same sector, you are generating only 1.43 for every 1 rupee of asset that you have, but your peer is generating a sale of 2 rupees for every 1 rupee of asset that the peers have. which means they're able to manage and take care of their assets much more efficiently compared to what you are doing. So this is an efficiency ratio or a turnover ratio. So it's not at par with the industry. Efficiency is not that great. There's some problem as far as efficiency is concerned. Any doubt with the total asset turnover ratio? Any questions till here? Okay, and let's look at the next one. Then we need to calculate the net profit ratio. So how do you calculate your net profit ratio? Net profit ratio is nothing but net profit upon sales. Again, here I'll take total sales. So not just cash or credit, but total sales. So I'll take net profit, which is this number, and I'll divide it by the sales, which will be the sum total of cash and credit sale. So take net profit divided by total sales, you'll get your net profit ratio. See if you're getting something close to like 2%. Again, this will be in percent, huh? So it will be net profit upon sales into 100. It's a percentage. So net profit ratio will be in percentage terms. Uh, 2.06. Are you getting 2.06? Net profit is what? 4,43,600, and then this is 2.2 crore. 2.01. Okay, fine. 2.016 is fine. I was just wondering what Excel has made some error. Okay, so you are as a company, you are generating a profit of only 2%. But if you look at your peers are generating a return of 3.5%, which means you're not at par with the industry. And again, we already knew that when we were looking at, let's say, the asset turnover ratio and the inventory turnover ratio, my profitability is not that great. So my profitability is low. I'm generating only 2%, peers generating 3%. As far as cost management is concerned, I'm not able to manage my cost properly. Let's look at the next ratio. Next ratio is return on net worth. So when I'm looking at return on net worth, how do you calculate return on net worth? Return on net worth is nothing but return on equity. So return on equity will be what? You look at your net profit and you'll divide it by the shareholders fund. So again, you already know your net profit. So that's 4,43,600, and then divided by the net worth, which is your shareholders fund, the money which belongs to the shareholders, the equity shareholders. So you'll take your equity share capital and reserves and surplus. So take these two numbers. So take the net profit divided by equity share capital and retained earnings. You'll get your return on equity, return on net worth. That's 4.6%. Compare this with what the others are generating. Others are generating a return of 10.5%. So you are giving a return of only 4.6% to your equity shareholders. Others are giving a return of 10.5%. So again, not that great. You're lagging behind as far as the peers are concerned. Then again, let's go back. Let's look at the next ratio that they've calculated. Next ratio is total debt to total asset ratio. So again, if I look at total debt to total asset ratio, so what will be my total debt? My total debt will consist of long-term plus short-term. So I'll take all of this. So I'll take debtors, I'll take creditors, I'll take bills payable, I'll take current liabilities. So that's my total debt. And I'll divide it by the total asset, which is this number. So total debt upon total asset, you'll get some answer. The answer over here is how much? 37.66%. This should technically not be in percentage. Huh? So it should not be in percentage. It should be a normal number. .37, 0.38, whatever. So if you look at your debt to asset ratio, you're telling me that if my assets are worth 100, debt is worth 38 only. But if I look at my peers, they have a debt to asset ratio of 0.6, which means if they have assets of 100, their debt is 60 rupees. So as far as my company is concerned, I have low debt. So I've got low debt. As far as profitability is concerned, net profit is low. So I've got low profitability. And as far as efficiency is concerned, my efficiency is also low. So low efficiency. So I am inferior to my peers in terms of cost management, in terms of efficiency, in terms of debt, and that will get reflected in my return on equity. My return on equity is lower than my peers. Because if you look at DuPont basically focuses on three things: debt, profitability, efficiency. And I'm worse off in all three. So if you have less profitability, less efficiency, less debt, it is but obvious that your return on net worth will be lower than the industry number. So even before doing the calculation, you already know that if my industry is giving a return of 10.5, my answer has to be less than 10.5. Subramanya, lower is better. Lower for what? The debt to asset ratio? No, there is no standard let's say number that you should have a low debt to asset ratio. Now again, some companies will prefer a low debt to asset ratio because of the sector they are into. Some companies will prefer a high debt to asset ratio because of the sector they are into. And some companies unnecessarily try to take too much of debt because they want to try to, let's say, increase the returns. But when you have too much of debt, it's an excessive debt, the risk goes up. So again, there's no standardization where I'll say, okay, your debt should be high, your debt should be low. It will depend on the sector. If you're a capital intensive sector and if you have more debt, I'm fine with that. But if you're a capital light sector, for example, you are an IT company or maybe a retail entity and you have too high debt, then that's wrong. I will not accept it. Yep. Any other question, anyone? Okay. Then let's go back to the last thing that they've asked. And I think the last thing that they've asked is the interest coverage ratio. Now, how do you calculate interest coverage ratio? Interest coverage ratio we discussed in the last class. Interest coverage ratio is nothing but EBIT upon interest. So it basically talks about the fact whether you'll be able to pay your interest on time to the lender or not. So if I look at the interest coverage ratio of the sector, it is 8. And for my company, it is only 5. So my company, it is 5. Industry, it is 8. And again, higher the ratio, the banker is much more confident. Lower the ratio, the banker feels that there's too much of risk in the company. So interest coverage ratio is also low. So any doubt with the first part where you had to calculate the ratios, compare it to the industry norms, and then comment and see where do you, let's say, are lagging and where you're better off compared to your peers. Okay, then let's look at the second part. The second part was where we had to calculate the operating cycle time. So for calculating the operating cycle time, basically what you need is inventory holding period, debtors collection period, and creditors payment period. Now, out of these three, we've already calculated 2. So we already have the inventory holding period, which is this. So that's 148.37. I already have the debtors collection period, which is 40.15. So I already have these two numbers. So I have 148.37. I have 40.15. I'll just calculate my creditors payment period. Now again, how do you calculate your creditors payment period? Yep. Anyone from the batch? How do you calculate your creditors payment period? It'll be 365 divided by creditors turnover ratio. And how do you calculate your creditors turnover ratio? It's credit purchase upon accounts payable. So again, going back to the question, I need my credit purchase, I need accounts payable. So accounts payable will consist of creditors and bills payable. So I've got bills payable, I'll take that. I've got creditors, I'll take that. So I'll take both. Okay, so don't just take creditors, take both, because accounts payable consists of creditors and bills payable both. So I'll take creditors and bills payable. That will give me accounts receivable. Now the question is, how do I get my credit purchase? Now the question doesn't mention anything. How much is your credit purchase? Absence of information, I'll assume that this entire material has been purchased on credit, and therefore I'll take that as my credit purchase. So now you know what's your credit purchase. So credit purchase is this material. You know how much is your accounts receivable, payable, which is your creditors and bills payable. You can calculate your creditors payment period. Calculate and see if you're getting close to 134, 135 days. Just check and see if you're getting 134 days, 134.47. 134.47. So now you can calculate your operating cycle time. Operating cycle time is nothing but your inventory holding period plus debtors collection period minus creditors payment period. You'll get 54.05. So I need out with the calculation for inventory holding period. Now, industry norm is 38 days. Your operating cycle time is 54 days. What does operating cycle time state? Operating cycle time states how much time does it take for cash to come back into your pocket. So for your peers, if they spend the money today, they will get the money in 38 days. But if you spend the money today, you will get the money back in 54 days. So this is where I'll start taking into account my opportunity cost, interest cost, money getting blocked, what is to be done. So of course, it's not at par with the industry. And because my operating cycle time is more, I'll incur more opportunity cost. I'll end up taking, let's say, a lot of short-term debt. Because I end up taking short-term debt, the risk will go up. The banker will charge me a higher interest rate. This will affect my profitability. Yeah, so it's not at par with the industry norms. So any doubt with this caselet on ratios? Yep. Any doubt with this? Anyone? So we're done with DuPont. We're done with ratios. What we need to do is comparative common size. Any questions still here before we move to comparative and common size? Okay. Then let's look at comparative and common size. Anyone who can tell me what do you mean by a comparative statement and why do you make it, and what is a common size statement and why do you make it? Comparative and common size. Anyone? Comparative, fine. Comparative is when I'm looking within the company. So I'm looking at what's happened within the company, let's say over the last 2 years, 3 years, 4 years. Generally, you look at the 2-year data, but it's not, it's not mandatory that they should give you data for only 2 years. But generally, when you look at a comparative statement, they'll give you data for 2 years. So let's say they'll give you data for 21, 22. So let's say they'll give you data for 21, 22. And let's say they'll give you something like sales, they'll give you expenses, and they'll give you the profit. So let's say sales is given as 100 crores, then it becomes 200 crores. Expense was 40 crores, then it becomes 60 crores. And finally, if you look at the profit, profit was 60. Over here, it is 140. So when I'm looking at a comparative statement, the first thing that I'll do is I'll calculate absolute change, and then I'll calculate the percentage change. So I first calculate the absolute change and then the percentage change. So if I'm calculating absolute change, I'll say, okay, 100 has become 200. So what's the absolute change? It has gone up by 100. Similarly, 40 became 60. So what's the absolute change? It went up by 20. And if I'm looking at profitability, 60 went up to 140. So what's the absolute change? Absolute change is 80. So that's my comparative statement. Yeah, so percentage change, it's all about the growth and everything. So this is absolute change. Percentage will tell you whether the sales have gone up, sales have gone down, and what has happened over the last 2 years. Then I'll calculate the percentage change. How will I calculate percentage change? I'll take the absolute change and I'll divide it by the base number. So let's look at it. Let's take it. So in this case, I know that my sales have gone up by 100. If I want to calculate the percentage change, I'll take the absolute change and divide it by the base here. So I'll take 100 upon 100, which means it's a 100% change. My sales have gone up by 100%. But if I look at my expense, what is the percentage change? Absolute change of 20 on a base of 40, which means my expense has gone up by only 50%. Again, without doing any calculation, common sense tells you that if your income is increasing by 100%, but expenses are going up by only 50%, your profit will increase. So if you look at your profit, what's your absolute change? 80. And divided by the base figure, so you'll get 80 by 60. That's what, 4 by 3, that's 133%. So profit has gone up by 133%. So this is how you make a comparative statement. Any doubt with a comparative statement? Anyone? Now you could have a comparative income statement. You could have a comparative balance sheet. So this is an example of a comparative income statement where I'll have sales, maybe I'll have other income, then expenses could be split. They could give you material cost, they could give you labor cost, they could give you depreciation, they could give you insurance cost, whatever it is. And finally, let's say you come to something like EBITDA, then you'll reduce your interest, you'll get EBIT, then you reduce your tax and everything, and finally you'll get your profit. So they'll give you line items, they'll give you the data for 2 years, calculate absolute change, percentage change, and then give your views. What is happening? Do you think the company is improving, or I mean, it's moving down, it's at the declining stage, or whatever. Similarly, if you look at the balance sheet, a comparative balance sheet, what will happen in case of a comparative balance sheet? In case of a comparative balance sheet, I'll do the same thing, but here I'll start with the balance sheet. So I'll have the data for 2 years, that's 21 and 22. And then I'll have things like, let's say, share capital. I'll have reserves and surplus. I'll have non-current liabilities, non-current asset, current asset. And they could give you a breakup also. So they could say equity share capital is there, preference share capital is there. I've got long-term loans. I've got long-term bonds, debentures. I've got property, plant equipment. I've got goodwill. Then this, again, they could give you a breakup. They could say, okay, this much is cash, this much is stock, this much is debtor. So whatever is given, just write it one below the other. Then write the numbers for the 2 years, that's 21, 22. And then again, do the same thing, calculate absolute change, and then your percentage change. So let's say, for example, your share capital was 10 crores. Now it is becoming 90 crores. For example, if you would have read the news, Adani Group is in the process of coming up with an FPO, follow-on public offer. So let's say this is Adani Group. Existing share capital is 10 crores. Once they issue new shares, share capital will go to 90 crores. So what is the absolute change? Absolute change is 80 crores. And if I want to calculate the percentage change will be 80 upon 10 into 100, which is 800%. Similarly, you'll do it for each and every line item. So any doubt with the comparative statement? So in a comparative statement, you're looking within the company. What has happened over the last 2 years? Any doubt with a comparative income statement, a comparative balance sheet? So I think we have one example on comparative. Let's just go through it quickly. So let's say this is my comparative income statement. So they've given me sales for 2021. Then I've got sales return, I've got net sales. Then they've given me the expenses. I've got opening stock of raw material, WIP, purchase. Then they've given me the power cost, depreciation, repair, labor cost. They've given me the closing stock. Finally, I get my cost of goods sold, gross profit. Then I take my selling expense, admin expense. Then I get my operating profit. So this is the data that is given. Now, using this data, I'll first make the fourth column where I'll calculate an absolute change, and then the fifth one where I calculate the percentage change. So just go through it, take a minute or so. Let me know if you are struggling with any part or if you have a doubt with this. As far as the income statement is concerned, comparative income statement. On similar lines, you have something which is a comparative balance sheet. Why shall we not calculate year-on-year growth? So which means you're telling me that I'll have some more columns which are like 22, 23, 24, right, Abel? Then over here, I've calculated year-on-year growth only. So I'm saying, what is my growth over 20? And then I move to 21. So in the last 1 year, what's my growth? Okay, so B4 divided by C4 minus 1. And what is that 1? That 1 is C4 minus 1, or that 1 is after the bracket? Okay, after the bracket. Okay. You want to convert it to percentage. Fine. Now, let's say if I just do it like this, which is B4 upon C4, that's this divided by this. And then I say minus 1. Tell me, have your sales gone down or your sales have gone up? Abid, have your sales gone down by 33% or has it gone up? Gone up. So I can't take B4 by C4. If I do this divided by this and then do minus 1, it makes sense, because now what I'm trying to do is I'm using that formula of compounding. Because if you remember at school level, you would have used these shortcuts. When you want to do calculation for compounding, this is what you do. So that's what you do. So now you'll say, okay, sales are going up and they're going up by 50%. So either go by this logic where you take the absolute change upon the base number, or take your C4 upon B4 minus 1. So if you look at a comparative financial statement for a balance sheet, it's on similar lines. You'll have your assets, be it your tangible, intangible, then you'll have other non-current assets. You'll take your current assets, and then you calculate your absolute change, percentage change. Then you'll have your liability side, you'll have your current liabilities, you'll have your non-current liabilities. Again, calculate your absolute change, percentage change. So any doubt with a comparative statement, comparative income statement, comparative balance sheet? Okay. Then let's move to the next one, which is a common size statement. What is a common size statement, and why do you think companies make a common size statement? Yep. Anyone? What's a common size statement? Why do you think companies make it? Okay, got an answer. Interpretation and outcome of the financial statements, compare with respect to sales, common, converting every parameter on a single unit, how much head is each percentage of revenue. Now again, I'll tell you, why do I make a common size statement? For example, I want to compare Infosys, which is a big IT company, with a small young IT startup. Both are into IT business and I want to compare them. So let's say I've got the data and I'm looking at sales, and I've got Infosys and I've got the startup. Let's say sales over here is 10,000 crores. Over here it is 1 crore. Then I reduce my expense. Expense over here is, let's say, 6,000 crore. Over here it is 30 lakhs. Finally, if I look at profit, profit over here is 4,000 crores. Over here it is 0.7 crores. If I start looking at these two companies and I look at the absolute numbers, then chances are that I'll always end up favoring the bigger company, because I'm looking at absolute numbers. So a bigger company has more sales, more expense, and it has a profit of 4,000 crores. But this company has a profit of only 0.7 crores. But then again, let's look at it. This 4,000 crore profit that you've generated is on a sale of 10,000 crores, which means what is your profitability? If I'm calculating, what's your profitability or your profit percentage? You are generating a profit of only 40%. But if I look at the young company, the startup, what's their profitability, the profit percentage? It's 70 lakhs upon 1 crore, which is 70%. Now my view changes. And now I start saying, no, the young company is much more profitable compared to Infosys. Just because it is operating at a smaller scale, we should not say that Infosys is much profitable. On an absolute basis, yes. Absolute basis, Infosys has a profit of 4,000 crores. This one has only 0.7 crores. But as far as managing costs is concerned, being efficient is concerned, the young company is much more efficient compared to Infosys. So that is why what you do is you look at a common base. So in case when you're looking at, let's say, a common size, you convert everything as a percentage of sale if it's an income statement. So if it's an income statement and you're making a common size income statement, calculate every line item as a percentage of sale. But if it's a balance sheet, then calculate every line item as a percentage of either total asset or total liability, because total assets and total liabilities will be the same, doesn't make a difference. So when you're calculating or doing a common size statement, look at whether you're making a common size income statement or a common size balance sheet. If it's a common size income statement, calculate every line item as a percentage of sale. For balance sheet, every line item should be calculated as a percentage of total asset. Of course. Okay. Got a question that this is not comparable as this does not make sense with capital invested and risk factor. Yes. But I'm saying if I'm just looking at these two numbers and somebody tells me which company do you think is more profitable? Absolute basis, absolutely, I'll say Infosys, because you're generating a profit of 4,000 crores and that's far, far, far bigger than 0.7 crores. But am I saying that Infosys is more efficient? The answer is no. I'll end up saying that the young startup is more efficient because their expenses are only 30% of their sales, but for Infosys, their expenses 60% of their sales. So this is just one way of looking at it. I'm not saying that my entire, let's say, ideation or my entire view about the company will change just by looking at this. But then if I don't do this, I'll end up favoring Infosys and I'll always end up neglecting the smaller company. So common size statements are generally made when you're trying to compare two companies in the same sector, but they're a different size. So you cannot look at the absolute numbers. What you need is relative numbers in percentages. So that is when you make a common size statement. So again, if I look at a common size income statement, so let's say I've got sales, I'll take sales, then they have given me all the other expenses, line items, whatever it is. And when it's a common size income statement, I'll take sales as 100 and I'll calculate everything as a percentage of sale. So for example, opening stock. How much is my opening stock? My opening stock is 1,50,000. What is my sale? My sale is 10 lakhs. So I'll calculate opening stock as a percentage of sale. I'll say opening stock is 1,50,000 divided by sales of 10 lakhs. On a percentage basis, my opening stock is 15% of sales. So now I'm doing everything on a relative basis. Every line item will be calculated as a percentage of sale when you're looking at common size income statement. Let's take another line item. Let's say I'm looking at selling and distribution expense. I'll take selling and distribution expense of 50,000. I'll divide it by 10 lakhs. I'll say selling and distribution expense is 5% of sales. So that is how you'll do. You'll take every line item and calculate it as a percentage of sale, and sale will be taken as 100%. Any doubt with the common size income statement before we look at, let's say, the common size balance sheet? The same thing is in case of a common size balance sheet. In a common size balance sheet, you take everything as a percentage of either the total of the assets or the total of the liabilities. So let's say I've got equity share capital, preference share capital, reserves and surplus. I've got some loan. So total comes to 7,70,000. So I'll take 7,70,000 as the total of the liability, and I'll calculate everything as a percentage of the total of 7,70,000. So when I'm looking at my equity share capital will be 2,50,000, and I'll divide it by 7,70,000. I'll get a number of 32.5. So I'm saying my equity share capital is 32.5% of my capital employed. But when I'm looking at, let's say, preference share capital, that is only 15.6% of my capital employed. Reserves and surplus are 6.5% of my capital employed, and borrowed funds are 45% of my capital employed. So in case of a common size balance sheet, take the total of the assets or the total of the liabilities as 100, and then calculate everything as a percentage of that. Any doubt with a comparative or a common size statement? Yep. Any questions? Otherwise, I think we're done. Yeah. Batch. Any questions? Any queries? Any doubt that you'll have? Okay. Just a second. I got a few questions. Which is not counted, which is not continued with current asset or current liability. Subramania, what are you? I mean, can you just be a bit more elaborative? Okay. Question paper format, like I said, I don't give MCQs or anything. You'll have descriptive questions. And if I'm not wrong, you'll have like 3 questions of 20 marks each. And I think the re-exam is for 100 marks, right? If I'm not wrong. So that most probably will have like 4 questions or 5 questions. So, but the first paper, which is for 60 marks, that will have like 3 questions of 20 marks each. So again, it could be a combination of numericals with interpretation. It could be a direct numerical, or it could be, let's say, a 20-mark question where I say, okay, can you please explain and tell me what do you mean by a comparative statement? Maybe for 10 marks, 15 marks. And then you could have a small subpart for 5 marks or something like that. So again, it could be a combination, either direct theory, a direct numerical, or a combination of theory and numerical, where I ask you to solve it, do the interpretation, something like that sort. Okay, comparative is calculated only with capital employed? No. Okay. See, again, I'll just go back to this question. Yep. So when I'm calculating a comparative, let's say a statement, basically there are different views on this. Some people, when they calculate it, they will not take current liabilities over here. They will take current liabilities on the asset side over here. So they take the current liabilities on the asset side, and what they get is working capital, which means according to them, what is the balance sheet? Balance sheet is share capital, reserves and surplus, non-current liabilities. Then they say it is non-current assets. Current assets minus current liabilities. This is working capital. So the total of this should be equal to the total of this. Other way of doing it is, instead of showing current liability here, I'll take it here. And then the total of this should be equal to the total of this. So again, the way you are comfortable, you can do it. So again, I'm not trying to see whether you show current liabilities along with current assets or you show it separately. I'm just trying to figure out whether you understood the concept. So you do the calculation properly and the interpretations are more or less in line. Okay, any other question? Important topics, everything is important. That's the only thing that I can say. Whatever you've done, whatever is there in your course outline, the async content, just go through it. That's it. Okay. Yeah, Vijay, I mean, I was just waiting for the session to get over so that I can connect with you on LinkedIn, because generally as a practice, I don't connect with students when I'm teaching them. Once I'm done, then I accept your request. So maybe today night itself, I'll accept the request, because I got like around 20, 21 requests and everything is pending. So maybe today night itself, I'll start accepting the request. Okay, Subramania, if I take current liability as liabilities, my percentage, yeah, your percentage will change. The percentage will change, absolutely, Subramania. There's no doubt in that, because instead of showing it as a current asset minus current liability, you're taking it over there. That's absolutely fine. But again, like I said, what I'm concerned is whether you've understood the concept, whether you know how to calculate it and then do the interpretation. So the percentage might change, but then accordingly your view, but the view will not change. So let's say if you tell me that the company has too much of debt, now whether you show current liability down or you show current liability above, I mean, you'll still end up saying that no, this company has too much of debt and it's majorly raising money through debt and less through equity, whether I show current liabilities above or I show it down. So the interpretation will not change, it's just that numbers will change. Term and exam, like I said, it could be descriptive, it could be calculative, it could be a mix of both. So maybe you could have one question which is entirely numerical based, one question which is entirely descriptive, one question which is a combination of both. Again, I don't remember it now because it's been like around 15, 20 days I had made that. So I don't know, but what I remember is that you'll have 3 questions of 20 marks each. It could be either of them. So be prepared. And again, questions are not that difficult. So if you've gone through whatever we've done in the class and you go through the async content, I mean, it should be fair. You have a doubt with respect to how buyback impacts the income statement and the balance sheet. Okay, buyback. So let's say when a company does a buyback, what happens? First of all, why do you think a company will do a buyback? Various reasons. Typically, if you look at a lot of IT companies, they do a lot of buyback. So they do a buyback because they feel that the share is underpriced. They want to increase their stake, and they want the, let's say, the other third parties to notice their companies if they are being ignored. So various reasons why companies could do a buyback. Now, when you do a buyback, typically what will happen is the cash balance for the company will go down because they have to pay money to the shareholders. Okay. And the share capital will go down. So if I'm making a balance sheet in a T format, and let's say I had share capital worth 100 crores and I had cash worth 100 crores, and let's say this is the only part of my balance sheet, and I do a buyback for 20 crores, my cash from 100 will go down to 80, my share capital from 100 will go down to 80. So the number of shares in circulation will go down. So number of shares in circulation will go down. And therefore, what may happen is that if I look at your EPS, your earnings per share will increase. Again, we haven't done this, but then because you've asked it, I'm just telling you, your EPS will go up. Because how do you calculate EPS? EPS is nothing but profit divided by number of shares. So because you're buying back shares, the number of shares will go down and therefore your EPS will go up. So that has its own impact on the share price, and accordingly it will take up the share price. So in most of the cases, or let's say generally you'll find that when companies come up with a buyback, the share price slowly and steadily goes up. But there could be instances where the share price doesn't go up because the market feels that no, the management is just trying to play around with the numbers. The company is not that strong. They just want to inflate the share price and they will not take it in a positive manner. So this news or this announcement of a buyback may in fact have a negative impact on the share price and it could go down. but generally it has a positive impact. Yep. Any other questions, batch? Otherwise, we are done. Okay. Thanks. It was great teaching a batch. Bye. Take care. Yeah. Bye, Satish. Bye, Yunus. Bye, Vibor. Bye. Take care. Yep. Bye, Pritpal.